All right, hello and good evening. My name is Seth Bolden, and this is our latest video from Phenom Group. The main reason for this week's video is, I think it was a week or maybe 2 weeks ago, that the New York Federal Reserve, published their quarterly household credit and debt report. Within that report, it basically indicated that consumer balance sheets are fine, but debt was rising. You get all these kinds of headlines thrown about the financial media and social media platforms, suggesting that rising debt levels, rising credit card levels are bad things. The first point I would like to emphasize is credit and debt levels rise in expansion cycles. You know when they shrink? The other thing. That's right, during recessions. So the fact that you have rising debt levels, rising credit card balance, total nominal credit card debt is validation that you're in an expansion cycle. The other thing I wanted to do here today is to kind of put it into a more appropriate context. And we're going to get into some other materials as well. I know the markets are in this consolidation phase, and everybody, oh no, the top is in, at least for the year. Maybe the top is in, period. And from here, we're going downward, especially with $1 trillion in credit card debt just revealed by that same New York Fed. So with that, we have this first graphic here. Now, I had tweeted this out for those of you who follow me on Twitter. You've probably seen this about a month or so ago. And no, this wasn't kind of preempting, the Federal Reserve's quarterly release of the household credit and debt report. I wasn't trying to do that at all. It's a matter of putting things into appropriate context, right? We want to have an ongoing understanding of the consumer's balance sheet. This is a consumption-based economy. As the consumer goes, the economy goes, right? And there have been calls for a recession basically since the middle of last year. And that keeps getting pushed out with each passing quarter that we are not in a recession. Nonetheless, it still plays up in headlines, and it still plagues the average investor. So hopefully these videos also help to distinguish how to go about either validating fears of recession or assuaging them. So with that being said, we have consumer finances. And so what I'm looking at here is this is a chart from JP Morgan. Yeah, JP Morgan. And it shows you, these are the liabilities. Liabilities is just a fancy word, $10 word, for saying debt. Of any level, of any regard. This is revolving debt, non-revolving debt, auto loans, and other liabilities. Other liabilities, mortgages, right? That's 66% of the average household's outstanding debt. And what I like about this chart is it really does put it into the appropriate context. The appropriate context is, this is the U.S. average household debt added up, and you get $19.6 trillion. That's a huge number, I know. $19.6 trillion worth of debt. But then you look at the total U.S. consumer balance sheet assets, and they add up to $168.5 trillion. So you have this huge amount of assets, and you have this what seems minuscule amount of debt. That's the appropriate context. Remember, it's not the size of the debt. It's whether or not the individual, the entity, the corporation, whoever it is, it's whether or not they can service that debt. Does it matter if I owe $1,000 or $1 million? If I can't make either of the minimum monthly payments, right? No, it doesn't matter. but the household assets help us to better understand, is this a bad number? And clearly, the answer is no. All right, so let's move on and consider why we go through recognizing these kinds of fundamentals or even macro fundamental issues in the economy. The market and the economy are not one and the same, but they do trend in the same direction over time. If we desire to know if the market trend is appropriate, we look for macro fundamental validation and vice versa. Right? What if the market is actually being expressing a bear market like we were last year? Well, when we look at the macro fundamentals, we look to rationalize, should I be buying this market? Is it possibly wrong? Should we be down 20% in the S&P 500 or not? What do the macro fundamentals say? If you were following the fundamentals last year, despite all the headlines and the fears of the Fed, blah, 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 inflation this, inflation that, and you bought the market down 20%, you would have done very well. Again, we look to the macro fundamentals to validate the market and the market to validate macro fundamentals. This is a chart that I posted last year. Percentage change in consumer spending from 2018 to at this point, 2022 last year. And one of the things that I was trying to depict with this chart was what was taking place in the economy last year. We were basically transitioning. Consumer spending was transitioning from goods spending to services spending. And a lot of that has seeped into this year. But we've seen a dynamic shift, or maybe normalization, I would say in the beginning of this year, when it comes to that disparity between services spending and goods spending. So the point that I was annotating with this $1,500 sofa versus this $100 dinner and movie for two was exactly what was taking place last year in the economy and how it actually filters into the stock market. What's that relationship between goods spending and services spending? How does it play out in the stock market for better or for worse? So this is like a durable goods item, a sofa, a refrigerator, a washing machine, those kind of items you might only buy once every 3 to 5 years. And when you've done that, well, what's left? If your wages are going up, you have a good job, well, it's entertainment, right? Especially when the economy is fully open and some of the fears, if not all of the fears, have been assuaged regarding all those COVID variants that were flying around in 2020, 2021. So you had a lesser goods spending nominal dollar in 2022, but you were having a lot of services spending, which carries a lower nominal dollar value or capture so far as GDP is concerned. So last year, GDP was trending lower from the beginning of the year through the end of the year, but it wasn't a matter of the consumer was having an issue. That wasn't the issue. It was just there was a lower dollar capture in their spending because services carry a lower dollar value than goods. Again, that was a chart that I had posted to try to explain the dynamic in the consumer spending that was taking place last year. Fast forward to this year. And we're seeing something, I guess you could say green shoots have been materializing when it comes to goods spending. The most recent durable goods orders was like oh my gosh, the beat on durable goods was tremendous. It was over 1% durable goods orders for the month of July. I'm pretty sure it was July. Yeah, for the month of July. I mean, you could see the tick up here in U.S. durable goods new orders and U.S. durable goods new orders for the various industries. I mean, they are trending higher. Now, last year, U.S. durable goods new orders, and basically since this peak in 2021, have been trending lower. We get into the new year and they've been trending higher. In fact, they've been up for 3 months in a row. And so here's the actual chart. I'll blow this up a little bit, get myself out of the way. Real personal consumption expenditures for goods. And you can look this up in the St. Louis Fed's website, and you can exchange this for services if you want. But the point that I had made earlier, we were in negative territory here in 2022. It was just downhill for good spending. And we had attempted a rally mid-year into mid-year, but it faltered. In November of last year, we still had negative year-over-year good spending. Calendar year changes, we're in 2023. It's been up, 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 up. So all of that good spending, all of that dollar capture that we had previously seen in 2020 and in 2021 is coming back to the economy. And this is a lesser dynamic. The services spending is still there. It's slowing, however. And that's okay. Why? Because this gives us the opportunity for a greater GDP, if you will, gross domestic product, or overall economic growth. There's more dollar capture in the goods side of the economy than there is in the services side. It takes many, many more transactions, many more services transactions to capture the same dollar spend from, one durable good item. Many more movies with the wife. Many more times at SeaWorld and Disney World with the kids than buying one sofa, one refrigerator. So moving on, again, we want to understand how this relates to the markets as well. Another chart that I found supportive to this whole conversation from Renaissance Macro Research: consumers want to buy things. They want to buy goods. This is from the University of Michigan. Buying conditions for large household durables is spiking higher, folks. Again, durable goods. Those are your household appliances, your major appliances, your furnishings, things of that nature, large-scale electronics even. This was from the latest University of Michigan Consumer Sentiment Survey. It supports everything that we've been seeing here in the increase in good spending. It's supporting everything we've seen here as well in durable goods upticking. All right, this is another chart from Macro Market Daily, and really it's just a reiteration of what I had just identified so far as the 3 months in a row we've seen manufacturing ISM new orders, right? The ISM, we know as a whole, the ISM manufacturing index has been in negative territory for many months now. But when you take manufacturing new orders less the inventories, we see that has been ticking higher now for 3 straight months. And the point here is that this leads the ISM manufacturing index, which is in white. This is going down, the new orders minus inventories. Well, the ISM itself is following. But we are now up 3 months in a row in new orders minus inventories. And we did see a slight uptick in the latest ISM manufacturing index. Now, we've seen that twice before, right? But it only led to lower lows in the ISM manufacturing index. What makes this time different is the fact that new orders minus inventories, that component, that ratio, if you will, is up 3 months in a row. That has not transpired before. That's the new nuance, if you will, with respect to the ISM index ticking higher last month. In other words, I'm of the opinion that we'll probably get back to 50. 50 is the differentiator between ISM manufacturing expanding or contracting. Below 50 is contracting, above 50 is expanding. We want expanding, that's growth. I'm of the opinion that the data here suggests we'll get to 50 by the end of this year. And it's the same thing that is identified here. This is from JP Morgan's Michael Sembelis in his latest report showing the exact same thing. New orders, less inventories in the ISM manufacturing survey is up 3 months in a row. Just a different way of showing the chart, if you will, in this table format. All right, and here we go. This is how we're going to connect all that macro fundamental conversation with the markets and why the markets are doing what they're doing. And don't get me wrong, the markets are never doing what they're doing for this reason or that reason. The markets are generally doing what they're doing for this reason, that reason, and the other reason. But we will, for this exercise, focus on at least one of those reasons. And that is the difference between goods spending and services. See, the market itself, most of the earnings come from the goods side of the economy. So S&P 500 earnings are mostly goods spending. The economy is mostly services. That's what you see here. S&P 500 earnings, the greatest composition comes from goods, 62%. The least comes from services, 38%. But the economy is different. The economy, most of it is services, to a lesser extent, goods, and then there, goods, and then there's this whole other category. So last year, right, we've already discussed, services is where most of the GDP was coming from. Unfortunately, that is not going to help S&P 500 earnings as much as we need it to sustain, a continued rally from 2020, 2021, and into 2022. So to the extent that earnings and the market expressed bearish conditions, it was actually validated, right? Because we saw a decline in goods spending. And by Q4 of 2022, we had an earnings recession, which has carried forward into the beginning of this year. So the goods spending, this macro fundamental analysis validates what happened last year in the market. Right? The market is forward looking. We didn't see the actual earnings recession start until about Q4. The market was pricing that in, though, based on what it was seeing in the dynamic between goods spending and services spending. Fast forward to 2023, we had a 20% rally in the S&P 500. The market's a forward discounting mechanism. It knew this shift towards goods spending was going to happen. Even though we still technically have an earnings recession, the market is pricing a rebound in earnings for at least the back half of the year. So again, the market knows well in advance and has been pricing well in advance what has been transpiring since the beginning of this year, greater goods spending that will eventually feed through to better earnings in the S&P 500. We good? All right. Hopefully this exercise is helpful. Now we're looking at a chart from FactSet. This is the projected full year S&P 500 earnings per share. And as we can see, let me try and blow this up here. So this is the start of the year right here. This is where we are now. And lo and behold, what do you see? Right? We have an uptick in the complete 2023. That's the bottom trend line here is 2023. The top trend line is 2024. So what we see here is an uptick. We troughed here back in July. The earnings tracking or projection for full year 2023 troughed in July, and now it's turned higher and through this earnings season. So everything that we're seeing in the macro fundamentals is playing out in earnings, and they're projected to move higher through the end of this year. All right, this is a chart, again, you've probably seen in my Twitter feed, but we also talked about it in our macro fundamental research report this weekend. seasonal sale for risk assets. We look at all, kinds of fundamentals, quantitative data, technicals, right? We got our charts here. I mean, it's very broad-based. Toward the end of our report, we talked about this analog. This is the 1966, 1967 analog. So much from that time period mirrors this time period. Back in 1966, S&P 500 fell 22% starting January. It bottomed in October. 2022, bottom fell out of the market starting in January, bottomed in October. The Fed was hiking rates continuously in 1966. There was a war raging in Vietnam. All of this sound familiar? Ukraine, Russia, inflation, the Fed's hiking rates. I mean, it's just very consistent. But what happened at the end of the, and by the way, midterm year, just like last year, midterm election year, which are usually bad for the market, or there's major corrections in midterm elections years. What this analog shows is the top line is 1966 into 1967, right? Up, and away. What have we done this year? Up, and away, right? So it's a very useful analog. I mean, the markets are very cyclical, and they tend to follow politics or the presidential election cycle. Coming into August, this chart, this is the 1966, 1967 analog. In 1967, you are here. August. What happened in 1967, the first 2 weeks of August? Down. What happened in 2023, the first 2 weeks of August? Down. But we tend to have a bit of a bottom here as well in the third week. Even so, through much of the end of the year, it was very turbulent. Do keep that in mind. It was a very turbulent back half of the year. See, we did talk about total U.S. credit card debt outstanding in our weekly macro market research report, which is delivered Sundays. If you don't get it, if you want access, subscribe. Our contributor membership gets you our weekend macro market research report. If you want to trade and invest alongside us, upgrade to our premium membership. You get all of our trade alerts. You get our trade and investment ideas as well. All right, let's go back to that analog. So I had tweeted this out here. I mean, people, they get all up in arms. They don't want to believe that the market is nothing more than human behavior that is engaging with price. They think everything is circumstantial. Well, in 1967, and I'll show you, this is hilarious. To me, some of these comments, basically, people are explaining to you that they don't understand markets or how they work or why they work. So here, let me see this guy right here. Did we have 30 trillion in debt with 1 trillion in interest? Did have the tax rates that we do now, or the high debt levels, or high inflation, right? So that was a comment to, this analog. When people do that, folks, just make it simple on yourselves. Just post this video. I'm telling you, it saves you a lot of time. It will save you a lot of time. It's not your job to explain to people, how the market works.
There's a good chance
and why it works.
Website right now.
Okay, so anyways, that's my take when people do that. All right, so getting back to this again, we're basically copying what happened so far. Now, these analogs aren't intended to be perfect. Very rarely does the magnitude of the trend perfectly match the analog. So we shouldn't anticipate or expect the magnitude of the S&P 500 rise and decline, chop, whatever it is, to perfectly mirror the rises and declines of 1967. It's more of, are we on that path? From time to time, we might be on different planes, but still on the same path. Now, with the market, pulling back, we'll take a brief here. I mean, rough day on Wall Street, but to be expected. I mean, we've known. Here's the other thing about, these people arguing with this analog is if you read the comments within, they'll think this is the first time it was displayed. Now, for our Phenom group members, you know that we looked at this analog as early as December of 2022. I even gave it to folks on Twitter. Here you go. This has a high probability. But, people see it for the first time and they act a fool. Not realizing that had they listened to this analog, I mean, that is some pretty profits, right? To date, those are some pretty profits. Excuse my grammar. So market is down pretty, and we finished below the 50-day moving average here today. Is that do or die? Absolutely not. Okay. We check back to the 50-day. We finished below the 50-day moving average. That is not the end of the world, folks. It happens all of the time. And as I posted earlier this week, it's the expectation. I would anticipate the S&P 500 finding support in and around the 50-day moving average initially, right? Because we could go lower. Impetus for a more meaningful correction is not fundamentally supported. What we're seeing, and that's why we do these exercises on fundamentals, to learn, is this normal? Is this to be expected? Or should we expect another bear market? Well, the fundamentals don't point to another bear market. They really don't. Given the resurgent goods spending likely leads to PMIs greater than 50 by year end, and markets generally front run such moves. They discount this in advance. So what's the next catalyst for the market, you might be asking? Wish I knew, but tomorrow we've got the FOMC minutes. Maybe that helps the markets to put in a trough. Maybe that helps the treasury market to put in a high water mark for the 10-year treasury yield. Maybe those things happen together and all of a sudden it lights a match and we've got our rally. With that being said, I hope you enjoyed this evening's video. Take care, everybody, and we'll see you next week.